In this video, we'll be covering the basics of security-backed lines of credit, called SBLOCs. Most people start investing in the stock market for one of these 4 reasons. 1 is to save for retirement. 2 is to accelerate your savings for a large purchase. 3 is to build a form of passive income for the future. And 4 is to use your stock account as collateral for a separate investment. In this video, I want to focus on number 4, because this is how millionaires and billionaires use their stock accounts, and you can too. If you know anything about owning real estate, you've probably heard of HELOC, which just stands for a home equity line of credit. A HELOC allows you to borrow money using the equity in your house as collateral for the loan. What most people don't know is that you can do the same thing with your stock account. This is called an SBLOC, which stands for Securities-Backed Line of Credit. Like everything, this can be a double-edged sword, but if you're smart about it, the main advantage is that you can continue to grow your stock account while using it as collateral to acquire other assets, like a down payment on real estate. Since this loan is a very low risk for the lender, they'll usually give you a pretty good interest rate, and oftentimes they don't require you to pay any principal besides the cost of the interest. In other words, you get to access the money in your stock account for a very small monthly payment. The goal is to invest this money into something that will give you a higher rate of return than your interest payments. The most common practice is to use your SBLOC for a down payment on a rental property. You take the rent generated from the tenant and split it between your mortgage payment and your SBLOC payment. And any left over can either be used as passive income or reinvested. This has 2 major advantages. The first is that your stock account is still able to grow. The hardest part of investing is growing your initial stock account to the point that compounding really starts to pay off. And the worst thing that you can do is start over because you decided to sell your shares. To put it in perspective, 10% growth of $100,000 is $10K, whereas 10% growth of $10,000 is only $1,000. The second advantage is that this saves you from owing taxes. I'll get more into this later, but when you sell your stocks, the IRS treats it like income and you have to pay taxes on that money. However, you don't have to pay taxes on debt, which is why this is one of the most popular financial strategies for wealthy individuals.